Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day, and before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. And today's episode is brought to you by MoneyMetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. And today's guest is the founder of The Market Sniper, a trader with 30 years of experience and an expert in technical analysis. We're going to be bringing his wealth of knowledge to bear on the silver sector, as well as discussing gold and uranium. It's Francis Hunt. Great to have you back on the show.
Jesse, thank you so much for having us back on.
So I want to focus on silver today because a lot is being made of the all-time high we hit last year in gold, but silver very far off of its all-time high. Sentiment very low, which I also want to discuss a little bit later. But I'm wondering how you expect silver to perform in 2024, because we keep hearing these forecasts. We heard them all throughout 2023. We were hearing it in 2022 that silver is going to the moon, silver is going to take off. And, we had the silver squeeze movement, which got a lot of people really excited. That brought a lot of emotion into the space, which I think hurt a lot of people who maybe didn't really understand the trade. So how do you currently see silver positioned, and how do you expect it to potentially perform this year?
Great question. And that sentiment you described is very a big tell in of itself. So important to recognize time frames when we talk about everything. Right now, if you ask me for the next day or so, I actually see silver coming off, and even for the next week, 2 weeks. But I'm expecting you asking me, Francis, if I speak to you in 6 months or a year's time, where's silver going to be? And for me, that then becomes a lot more interesting. And the main driver, it's kind of the truck and trailer, and I call it, you need to visualize the relationship of both gold and silver as a kind of where gold is the truck and silver is the trailer. And instead of a traditional tow bar between them, there's a bungee cord. And what tends to happen is you start to hit a big hill, and the 4x4, the truck, floors it and starts to pull quite strongly, and the cord starts to extend. The bungee cord that you strangely using as a tow rope actually is the gold silver ratio, and what you see is that extends, and the heavy trailer of silver starts to fall really far behind, hardly moving at all, while the 4x4 is going up. Now, when I'm using this analogy, that in actual fact there's potential energy then being built up in the super thick, it must be said, bungee cord, and eventually you get a catch up, such to the point that the trailer can come whizzing past the truck itself. So I like simple metaphors to help people get along. Now, the answer to that many people say is, "Oh, Francis, we're sick and tired of hearing one of these days silver's going to happen. You mentioned it yourself. You get fatigue." I just want to point out the first time we ever called a turn in the debt markets and said the debt markets will not be the perpetual bull markets, the buy the damn dip. This is a 40-year cycle, was during the year of 2020. And since then, yields have gone up, even though there's been pullback periods. You're in one of those now, by the way. It's probably worth us later having a short thread on that. But nonetheless, it takes a long time for macro trends to end. But when they turn, they turn and they turn and they stay turned, and they then move for a very extended period. And in actual fact, they play catch up in the opposite direction. In short, I brought in the debt markets to explain your question on silver, which I've tied also to the question of gold. So I'm adding a lot of variables in here, but I'm doing this intentionally because we've had a 40-year bull market with dips and rallies in debt. That's an escalator. It's a very flat, lengthy escalator. Watch the hand. It's kind of like that. You do not get a 40-year mild decline like that from that escalator height. You take the elevator down. It's the end of a debt system. There's not a symmetrical corresponding unwinding event. It is far more abrupt, harsh, and rude, and it's really fast. But for that setup to occur, it takes a bit of time. Essentially, we're waiting for an elevator cord to snap for the debt market. Now, why talk about the debt market when the question's about silver and gold? Because they are the two competing money systems. So one involves a banking system, which is an intermediating. You borrow money into existence. You have a T-bill account, an asset and a liability. You take out a mortgage, you own a property, but actually the bank owns it. That becomes, you are their asset inherently. That is the current financial system, which is in the process of breaking. Now, the turbo juice, as I like to say, for both gold and particularly that lagging with real tension in the bungee cord rope silver, really comes to life in the capitulation and failure of the other alternative. When both, we kind of have a parallel system. You do have both as money systems. It's just gold and silver is not effectively being used as one materially at any great level. Gold is starting to be used again as store of value rather than debt. So that process has already begun. But in terms of daily transaction money, silver doesn't have a role yet. It's just an industrial metal that's supposedly a bullion. So what happens is as the debt collapse occurs, and in this question, I'm tying other markets to it, and I want to point out to everybody, March 2020, peak bond valuations. The rates, the yields dripped right down to 0.3 on the US 10-year debt markets. That was the point that the gold-silver ratio simultaneously. So for those that doubt that these two things are tied at the hip, the success of one is the failure of the other, and the failure of the other is the success of one. Just go look at the technical charts. The 128 gold-silver ratio occurred as you had peak bonds. 0.3, buy the damn dip. Everybody from a lot of the stars that we follow on Twitter with massive followings, buy the dip on bonds, wear diamonds. That's what they're saying. We came out and said, buy the dip on bonds, wear coal. And in fact, that's a slur on coal. Coal has actually got great use as an energy use case and will probably hold its value far better, apart from not looking particularly fashionable if you're wearing it around your neck. So in terms of all of those things, silver's fate is tied to gold, even though there's this divergence. It's a very thick bungee cord. It can stretch real far, but the notion that the relationship will be entirely severed is wrong. So everybody who's sitting here and saying, damn, silver looks soft, like it's going to go lower. It's at about 23 and a half, and it's drifting off. You could drop again to the low 20s. That's primarily because gold is also looking a little bit toppy. Should we refer to the charts to take on that technical side, Jesse, and let you unpack some of that in the meantime?
Definitely.
I'm going to start with gold, then with your permission. So here's what's happened that's kind of super important and that everybody is a bit jaded about. And this is exactly how markets go up. You first show, and I'm actually going to pivot this just to the monthly to make the point, because it's on the monthly time frame that most people need to see that we actually had a seminal event. The blue line is the $2,000 event. It was a huge event also in the $1,000 when gold breached the 1,000. I've covered that many times, but I think we don't need to revisit that history. So this failed to close on the monthly above 2,000. This failed to close on the monthly above 2,000. These two shooting stars, those are, and that was also a shooting star over here, are exhaustive candles that traded through but couldn't hold. November was your first and foremost candle to ever close on a monthly time frame above 2,000. And I'm taking significance out of that many people are started to already feel jaded with, because the next candle went as high as 2,150 and got slammed all the way down. And they said, you jinxed it, etc., etc. This is how breakouts occur. You resist 3 times. You just run and then you resist. So this is part of HVF method, which we are known for in terms of understanding price behavior. The level gets run, but it's not held. 3 times you play with a line. 3 times you push back. That is the testing phase. Don't forget, in a bid and offer stack, you are thinning that offer stack out each time that happens. And more debt is being issued, more unsound money principles are being pursued, etc. Then you get the close. What happens is, okay, now you've broken, but you get the return move. We are quite possibly even on gold, by the way, which has been shown a little bit more strength and spine than silver for now. And that's exactly how precious metal bull markets roll, guys. Gold is the driver. The engine is in the 4x4, not the trailer. It drives first. It leads, it steers. The tension must be taken up in the bungee cord. The trailer does lag until eventually so much built up inertia and potential energy is built up in the rubber cord that it then overperforms later. So in any bull market for precious metals, you need to be in gold first. People underrate it. They go, oh, silver's going to go up more. Let me go buy silver. And then they say, wow, it never happened the next day. It never happened the next week. It didn't happen the next month. That's unfair. It's never going to happen. No, people told me the bond market would never turn. We were supposed to get negative interest rates. People were selling 100-year Austrian debt with negative interest rates. 100-year. You want to give away your money and get guaranteed less back in a fiat proliferation thing. That is peak insanity, and now everyone's woken up. Those bonds must have lost I don't know how many percent. So we've had the awakening to the debt crisis. So the people bailing on silver now and with the impatience are actually leaving the nightclub just before you two walk in and start playing. Literally, the party's about to get started and they're going, damn, we waited too long. Who do these guys think they are? Storming off in a huff. The debt market collapse is the beginning of that turbo juice, and it drives first through gold, and it needs to be recognized by the central bankers, such as the likes of China, Russia, who are already doing this. So all the facts are here. The problem is people lack patience. They're seeing the dominoes falling slowly but surely, but they're giving up. Don't get into silver if you don't have the time frame for silver. You must match. This is a key learning point. You must match your time frame to the investment category. If you want it tomorrow, next week, next month, don't buy silver. Buy gold. Buy gold right now, or even buy, something that's got inherent momentum right now before gold. Even gold is going to possibly have a small pullback here. It could return to the 2K and just run it to the downside and then rally. In fact, it's already done once. So we are going through the 5 stages of a breakout, which isn't into a straight line up stage. That is what we call the melt up stage, and that's normally stage 3 for us. So you're going through the break and feigns, then you go through the second chance, and then you go through the melt up, or if you're on a downside like debt markets, the capitulation. But believe you me, those aren't going to be nice times. There's going to be crazy geopolitics. There's going to be lots of misinformation and deception. There's going to be money lost in banks. A lot of things are going to be going wrong. Of course, if you overweight in the precious metals, you can be happy. But first, gold. And gold hasn't gone into its melt-up stage yet. And when it does, that's probably when silver will start to too. But you might see a final little stretch in the cord where it's at its absolute breaking point and it manages to go a little more. And then suddenly, wow, it's almost like that bungee cord is turned into a pole. And any further upside from gold is just going to yank the trailer up, and all that potential energy is going to go. So that's the framing. Match the time frame. If you haven't got multi-year time frame, even decade time frame for this move, we're talking about a systemic global collapse, something they don't want to have happen. All the forces are holding back. So the weight in that trailer is just on that hill, just making it hang and barely roll up the hill at all. Everything is working against it until it loses. So it's like a dam wall bursting. It's going to keep resisting. The water pressure keeps getting more. That's part of your upside, because when it bursts, the higher that water line is to the dam wall, the bigger the flood downstream. And that's what we're playing for, the power. And the longer the resistance, the greater the surge and the eventual move. So there's a proportionality to everything, and it's a big time frame trade.
Very interesting. And I like that you mentioned having a long time horizon there. I wanted to ask how you personally approach the silver space. Are you sitting on the sidelines at the moment, first waiting to see gold move? As you mentioned, that silver tends to lag gold. And which vehicles do you use as in silver investment? Do you hold bullion as a form of money? Do you also invest in any proxies to the price, such as the ETFs? Do you invest in the miners at all? Are you looking at those? How do you approach the space?
So, again, a great question. Let's deal with the last part. Do I go for the miners yet? The answer is not actually yet. You have so much time, and the time frame for this is large. You have both. You mentioned Rick Rule, who's delighted that there's more time. He can stack up some more, and in some senses, he's right. I don't feel right now the miners are going to. So the firing order. This is like you're sitting here, and we've just popped the lid on my amazing Bugatti W16 engine. There's so many variables in here, and they have a firing order. First it's cylinder 1, then it's cylinder 9, then it comes back and does 2, and then 10, and every cylinder will fire at some point. So we're watching it, and we're trying to track in which order are these dominoes dropping. Gold, the bullion, first on central bank buying. You know what? Tick. We've already begun that phase, but it's not a one-day phase. It's a 3-year, 5-year phase. It's been happening for a while and will continue to happen. Next phase, the other metals start to stir, such as platinum, silver, the platinum group, which you've already had, rhodium, very rare, and palladium, multiple shoot. So don't forget, there's other little bit part players that have already started and partied and now are actually had a big bear market collapse, actually, in palladium, which we've called, and in rhodium, back from almost in the 30s down to 4s. Now, that was supporting platinum being sold under value in South African mines. Now that's not happening. So that's going to lead to a greater platinum price in time, but not yet, because you're trading at cost. So the miners will follow, but they'll probably follow last. And in some cases, particularly the marginal miners that are barely turning a buck, they will follow at multitudes, but don't position too soon if you haven't got the patience of the timing. So everyone wants to buy for today. So just looking at the gold chart over here, it's not about to explode technically for me post this. I could see it drifting off and calming down and putting everyone back to sleep. That is the absolute sign of the setup. But putting everyone to sleep at a point where it's now actively got base camp above the 2K level. And people aren't seeing the significance of that. What was a resistance 3 times on a monthly close now becomes a substantial support. And this is progress, but it's not fast progress. And it's designed to dopamine you. You're being put to sleep. The intravenous injection of morphine is going in there and you're being lulled away. It's very hard to recognize that incrementally you are watching a tortoise move here. And you're not even sure it's moving, but when you look away and you look back, you see it's not quite where it was. This is designed to catch you because that tortoise suddenly turns into a rabbit and it's off like a dirty sock. And then you've missed the game. So inherently you have to watch the slow phase because it's designed to shake you out. Other things will be pumping. Crypto, Bitcoin, woohoo, go look somewhere else. There's no party here. You come for your New Year party and, the band hasn't even plugged in their guitars yet. Everywhere else there's music going, you run away. Boom, you missed the main event. So that is my message. Gold looks like to me that it can come off. And if it does that, I wouldn't be surprised to see silver actually come off a bit more if I'm looking at this. Inside of its established range. So it can come to low 20s. It could even do a 20 again. It depends, there's narrative being created by the central banks that there's going to be, they're pricing in all these cuts. Suddenly, one thing I would love people to understand, they get too taken up with central banker narrative as well in terms of your question. So everybody thinks, they're going to cut rates. That means stock market up, et cetera, et cetera. It's going to be, the economy is tight. They're going to be giving some alleviation. Well, the point of cutting rates means you're valuing up bonds. Where my hand represents the value of bonds, cutting rates means that goes down and my elbow has to go higher. That means valuation up. But hold on, they're going to be issuing more debt than they've ever issued. They're getting a reduced tax take. They're funding wars in Israel, in Ukraine, everywhere else, all these extra normal activities requiring funds. It seems like a money laundering racket for me involving the usual suspects, but that's just me. How on earth are you going to do it? They're trying to break the economy, drowning it in debt. How does the valuation go up? Who's going to be all these buyers now after the major turn in debt markets, which everyone has now realized finally 3 years later, who's going to be all these new buyers at these super low globalization rates when we were all working together and China was the workshop before bifurcation, before Russia, Ukraine, and this increasing hostility with China, before the BRICS really starting to become more of an alternative bloc, now pushing up costs of manufacture. So you've got an inherently a much higher interest rate environment to cope with. You've got the big gift of the Goldilocks economy brought to you by Greenspan, where we outsourced everything. Asset prices were allowed to run. That is inflation, by the way, asset prices running, but you didn't get cost increases on your clothing and everything else because you workshopped everything offshore with child labor and other things where you didn't have such laws that allowed you to do it at home, now being done in India and all of these other places. Now that gift is being taken back, and now you've got this absolute proliferation of debt that has funded an asset boom. Who now wants to buy bonds that the bonds are going to really drop really far? Because if interest rates are to drop, the valuations of debt has to go up. That's the relationship. It's not going to happen once people have realized the debt game is over. You get the elevator cord snap event, and so all we're getting is a bit of mood music, and that is why central bankers across the world as well, Jesse, have said, hey, higher for longer, don't over assume big cuts are going to occur, etc., etc. Why are they all saying this? They are establishing alibi for the fact that the debt markets won't be able to sustain very long devaluations in yield and increases in capital value. Because who's going to be the buyer? They know the investment world isn't going to be a great buyer in here. So the debt collapse is part of the gold silver run in the end, and they are coordinated. Hence why, as I say, on the gold silver ratio, I'll just bring that chart into view again for everybody. The March 2020 events, this huge spike, absolute moon over here to the 129. When did it occur? I put the cursor there. You see at the bottom, the black number, March 2020. March 2020. At the same time, the bond markets, if we go to US 30 and we do the monthly there, these things are 100% coordinated. There's the absolute capitulation. That's how trends end. Downtrends in yields obviously was a bull for bond markets. That's how they end. What's the date? March 2020. That was a cyclical turn of events, and gold is already in the beginning of its bull market, and silver will follow in lieu of that.
Very fascinating. You know, one of the main bearish comments that I hear when it comes to gold, but especially silver, is that the market is so rigged, there's no point in even playing the game. There's going to be multiple of those comments below this video, by the way. It seems like every time silver is brought up, it's inevitable. So I'm wondering, do you see manipulation through paper contracts as an actual big factor when it comes to the silver story? And if so, do you see that manipulation coming to an end at any time?
So you will get those comments. I get them too whenever I do anything bullish about gold or silver. And here's the facts. Central banks have been intervening in markets since forever. So when we called the euro Swiss franc collapse, there were two, by the way, one in 2015 and one earlier in 2009. When it was 150 to the euro. The euro was this all-conquering currency. And that was post-subprime. Of course, we had rotten European banks that were in deep, deep trouble, etc. It was the precursor to the pigs crisis. The central bank, you can see it in the price behavior, were already intervening and holding levels. Everybody thinks this is the first and only market that's ever had a statist major player be involved. The point is, you can hold back the tide. I can take an absolute ton of bulldozers and build a sand wall and try stop the ocean from coming on here just outside my window for a while. I can do all sorts of things to try dam up the Atlantic Ocean from washing in, but eventually you lose. What ends up happening is when you create a distortion in the market, it continues to distort and become ever more extreme until the participants no longer want to hold up the perverse hypervaluation end. And then it becomes everyone watching everybody else. Somebody's going to get shot in this room and nobody wants to stay. And everyone's looking at the door and waiting for somebody to twitch. And then they all turn and run at the same time. Because there's a shooter in the room. And that's kind of the situation you end up with. Who's going to hold up the lie once it's so obvious and so extreme and so costly to do and so damaging to do that everybody wants the reset? Till eventually, even those that were part and participants of something that were unsustainable change their mood music to, well, it's been known for a long time that we've had distortions and there's been too much debt. All these guys that are telling you today, there's no issue with the debt, we can continue to operate, all will morph their message just before the ball is being dropped. So that you can manipulate, you can use leverage for a while, but somebody is going to build a massive deficit position of great quadrillions, millions, trillions, etc., a banking cartel. And eventually they're going to fold that as bankrupt and they're going to try roll up all that debt. What happens is you never get true market discovery in the normal market, the control market, and then bang, they just have to reset it at something that reflects the normal price at some level. I don't think, personally, in my mind of game theorying this whole thing out, that you will get free markets take you to the true value of what gold should be and what silver should be for the amount of money that has been borrowed into existence. I think it starts to move in that direction. It starts to go into the elevator snapped cord and they freeze frame and they go, okay, no more, it's broken. And they will use some sort of geopolitical event. Who'd have known China had hacked everybody's bank accounts, Iran had hacked everybody's bank accounts, something like that. Geopolitical event. Oh, we all lost our money. We got to start again. Sorry, guys, everything back to zero. And then you get a set value instituted by your oligarchy for gold and silver. You have to register as a gold and silver holder, and then the capital gains tax starts flowing, and all the other things that are typical of extractors and status systems. So I don't actually think we will ever trade through to full truth. I think we'll get to a point where you will potentially move in that direction, and then suddenly the whole thing resets.
Now, I want to talk about uranium as well, because last time I had you on the show, we were talking about it a little. We didn't really have time to get your full thoughts. 2023 has been a hell of a year with the sector. The spot price is at 15-year highs. A lot of the equities have also performed very well. So I wonder what your current thoughts are on the uranium sector. Do you think there's still a long ways to go here? Are we in the early stages of a uranium bull market in your view, or has the big money already been made?
So in terms of macro commodities, generally, so that's the broad category from energies to the money alternatives, which is the gold and silver market, and the soft markets, the softs, the agris. So I'll give you a general statement on macro commodities. These are in a very bullish state, generally, as a whole. Energies, I'm going to put a small mark around them and just make a key comment. Generally, energies do have a real correlation to economic activity. Note I said energy is not uranium. So oil will likely underperform gold. So we have a money and capital preservation crisis at the moment, hence why gold first, and then later silver, then all the mines, possibly gold miners in and around silver, maybe one or two before. They've already started. So money, true money, as in gold and capital preservation, is now a higher priority than yield. So we've had the search for yield 40 years. Now we don't want to talk about return on money. We want to just talk of returning money and making sure it gets returned. And that is the capital preservation. So I see gold being one of the better in the macro commodity crisis because of its money, and we're having a money and debt-based crisis. If we have a demand-destroying event, and March 2020 was such an example, energies generally, so I'm more thinking oil and other things than specifically uranium. I'm going to mention that's why I think uranium is unique in the energies category in a moment. But energies generally will drop. So I'm preferring, we had a real rainmaker trade, being long gold, short oil. During the prior in 2019 macro trade into the events that turned out to be March 2020, which I won't say the name of, and that led to a a huge year for us. We were short liners, cruise liners, pipelines, and the commodity oil itself, and long gold. So we had a commodity neutral. So generally, I think oil could in parts go down inside an inflationary environment where generally it's going to be going higher mostly, but on account of loss of freedom of movement, things similar to lockdowns potentially taking place for whatever narrative, climates, pandemic Mark 3, 4, 5, things like that, and loss of economic activity, which is part of impoverishing the masses and making billionaires ever wealthier. So we're having this polarization. Remember, inflation is policy. It's central bank policy. And inflation makes balance sheet, people that own things with cheap debt, which you don't get to borrow at cheap debt, credit card being the most expensive debt, but even if you take car finance or if you take business finance, you don't get cheap debt. They get cheap borrowing and they buy assets. So the billionaire class gets richer. The rest, the upper middle, to the lower middle, to the working classes, all get impoverished. So this is a game of polarization, of pushing everything. Though the economy still relies on a consumer, and the mass consumer will not be oil strong in a demand destroying event. And we should expect that to come, because it's going to be the subterfuge that hides the debt failure. So there's going to be another geopolitical narrative. I've given you the global hack. So I prefer gold over oil. However, uranium is the best, in my opinion, of the energy classes fundamentally, because there's a sudden redawning of the value of nuclear power relative to all the others for the green agenda. It got stuffed during Fujitsu. I said Fujitsu, I think I mean in
Fukushima.
Japan. Fukushima, sorry, we actually long the equity Fujitsu. I'm totally dyslexic. Fukushima, nuclear crisis, and then of course Germany cancelled nuclear plants, and you've had that uranium guys were sitting there like silver guys are today, saying it's never coming, it's never coming. So uranium, if we look at the chart, it had a collapse as well to a final shakeout low, and this is often what happens just before you run. They want to kill and humiliate the bag holders that have been holding forever. Do not, if you have a sell-off in silver, panic out if it drops. You've got to hold. This is why I'm not leveraged. Part of your previous question that I didn't fully answer is how am I playing it? Investment only, generally. Only if I get a unique setup am I actually using any form of leverage. I'm investment only, silver and gold. It just sits there. It's a hold. There's a little bit of cost to carry sometimes. It's got nothing to do with banks, and some of it you keep privately, but you just sit it out. You've got to guts it out, and you mustn't be a forced seller. Note our uranium over here, and I'll just draw some lines on the chart here, had a final capitulation also with this global macro demand destroying event, which I expect another one with a different theme to come. Flush out before it then did up, 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 up. And there you have three legs up, and you have two sideways legs. This was kind of a broadening structure that I'm highlighting. You had a falling wedge here, and then you've had your high. That's your first leg advance for uranium. Then we went into a sustained period. We were a little concerned for uranium. I haven't been perma bull. We said, hold on, there might be a chance of a head and shoulders, left shoulder and a head here. And we were watching this. It said it needs to not break here. So we were watching the 2850. We're on Sprott uranium as a proxy for uranium, by the way. Out of you like it. But since then, it clearly shrugged off this level and has wound up, and I think it's looking pretty good. But we could, just with some softness in the market, see a little bit of a retrace and then maybe a bounce back up, and could end up with a rather nice setup. But it's not I wouldn't say right now energies are going to be a major runner, but I think, again, you could go higher in due course because you're very close to previous highs. And I will highlight, the last time you were at these highs, you were in a blow-off state. This was really strong momentum. So you were kind of like an absolute surge that came out of that falling wedge interaction. This has been quite low volatility. It's squeezing higher and it's very close to that legacy high. Could just have a little drift down a little bit, I would guess, to break into the new high. And then that could set up something that could be a nice squeeze setup. So it's a watch for me. If you get a bit of triangulation like that, it's a watch for me for future trade. I wouldn't jump in that close to the highs. I think it could ease a bit and you could get back in. But broadly, uranium positive about its future progress. And I see it as the star in the energies category. So I hope that's clarified everything. I would be investment only, and I would wait. I would have some limit orders down here. One of the things you can do, which is very powerful technically, and we teach this in our program, is you can see where the bulk of the volume is taking place. And for that, you have what's called volume by price. You see that blue line at 28.50. I'm going to draw where's the volume taking place over that area since we jumped on the ledge. And you can see the bulk of it's been kind of lower third. You've tapped on the top a while. It's rare that after just a small amount, 70% is the dark blue. So you're not looking at the floor very much. That's good news. You're holding the low end of the 70% range is our 28.50, but you're about a third of the way up. So a lot of the volume has been around here. So it's kind of consolidating. What you tend to get later is that you'll start to have more tapping on the ceiling. So you'll pull back a little bit and you'll start stacking these bars a little bit higher, and then you'll pause for a while, you'll have another attempt. Remember, 3 attempts, and then on the 4th you break. Much like I said on the gold, you're at probably number 2 now for that new high on balance of prop. So a little bit of a squeeze here that I would suggest might see you come off a tiny bit, but not scary bad, but a little bit of a squeeze. But then again, not tomorrow, not next week, not next month, but in due course, I would expect higher uranium prices after a consolidation, a more sustained consolidation here. A lot of it's going to be on economic weakness on the consumer, but uranium is a bit more insulated than that, than oil for cars and movement.
Right. Well, I wanted to follow up really quickly on your comments regarding oil and the energy space. Are you bullish on that space over the long term, say over the course of the next decade? What are your thoughts there?
Yes. So again, as I mentioned, if we go to US oil, which is WTI typically, I do feel this is what happened March 2020. Now, there was very specifically an end to movement, but I do feel that you can't rule out such a thing happening again. And this chart is not looking nearly as good as the uranium chart. On the uranium chart, you had 2 highs, and the second high was almost as high, and you're holding a blue line at 28.50. If you look here in the oil chart, you can see exactly what this is telling you. This pulled all the way back. We called this top on a bit of technical analysis here, and it's come right the way down. And this rally is not nearly as strong, and this is pretty flat. And can I also point out, OPEC Plus, which includes Russia, has twice done production cuts. So the notion that this economy is everything is awesome. I prefer the image of the dog drinking his coffee and everything's burning on fire, if you know the difference. And he's saying everything is awesome. This is not on 2 production cuts a good, and that's again, statist involvement. They're matching the amount of production and they are cooperating so that they don't both force a glut as we had over here when they weren't cooperating and everybody wanted a minimum amount of revenue. And as the oil price dropped, pumped more oil to make their number. And you got an absolute glut at a time where everybody stopped driving, stopped flying, and stopped doing everything. Well, that's a great way to screw your market up, as you then saw. And I think we went from a few hundred offshore drills to about 3 or 4. And most of them hit the wall. So this is not technically strong compared to the uranium, and I'm hoping guys will appreciate that. And I could see on a further weakness in the economy, us trading below that level. So what is that level that you kind of a floor on at the moment? Let me just grab the price chart. Just roughly around the 70s level. I could see us slipping through the 70s. into the low 60s and possibly the 50s. So I'm not short or even medium term on account of the consumer and demand destructive events, which we are already in with the super high inflation, which is higher than the BLS numbers are telling you, the debt state of the debt collapse, and the potential for more downside event risk. Let's just leave it there. So that is not a good setup for oil. That is not a good setup for oil. We already have all the wars. We've got an Israel war that's likely to expand into Lebanon, chasing Hezbollah. We have Ukraine, Russia that can always escalate. None of that's done anything for the oil price. We've had 2 production cuts. That tells you consumer wrecked, not flying, not driving, and it's also in packaging, it's in deliveries, it's in everything. So oil is much less interesting. Longer term, if you talk in 10 years, if the system is, and we could still price it in current dollars, assuming that currency still exists, I would expect it to be higher, but not the star performer.
Well, thank you so much, Francis, for joining us today. It's been an awesome conversation. I learned a ton. I know the audience did as well. Before I do let you go, could you tell us about the Market Sniper, what it is you do there, and anywhere else you want to direct people online? Feel free.
100%. Well, thank you, first of all, for having me on, Jesse. I think 2024 is going to be a seminal year. I think a small percentage of money, people are going to make an immense amount of money. And that could even mean involve being on the short side, as well as certain markets that will serve you well on the long side. The rest, I fear, are going to have a wealth destruction. It's a polarization event year. I want to highlight that. The 4-year cycle in Bitcoin is happening. It seems to be coordinated with a quantitative easing cycle for every 4 years. Last time, major quantitative easing in 2020, you may remember. We had the Shanghai Accord in 2016. We also have a third thing, the election cycle. So they tend to dump a bunch of mess on a president that's just leaving, so that the new guy says, well, I'm cleaning up the other guy's mess. It wasn't on my watch. So you have a presidential cycle, quantitative easing and tightening cycle that's at apex is here. 2024 is going to be a seminal year in markets. It's going to be potentially very volatile. There could be hits coming and then subsequently the usual cures. I want to be positioned well for that. We specialize in wealth creation and preservation in reset times. The traditional financial advice is the worst for a transition from the old locomotive on the rails to the new monorail. You have to make sure your baggage, aka your wealth, is not left on the old train to go over the cliff. You are arching it over to the new monorail. They want you stripped clean so that you can be ward of state and you'll be compliant. You will take your UBI and anything that they set as conditions for it. I aim to purchase you your freedom by retaining wealth, building wealth, retaining it, and carrying it over to the monorail. You can follow us on The Market Sniper on YouTube. For those that have a crypto interest, the Crypto Sniper as well. It's a separate channel on YouTube and under the same acronym or handle on Twitter for our charting. Our community, book at a call on themarketsniper.com should you be interested, but follow first on YouTube, and we aim to help you achieve those very specific objectives. Wealth building, wealth preservation in reset times, abnormal times, and 2024 is going to be a very interesting year. The Chinese curse will apply.
Well, awesome. I'll put links to all of those in the description below for people who want to check it out. Thank you once again for coming on. It's been a blast, Francis, and look forward to doing it again.
Thank you so much for having me on, Jesse, and all the best to the new year to all your viewers watching and to the ongoing great progress of your excellent show. Thanks for having us on.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get $10 off your first purchase. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.